Welcome to today's bond trade. Another Tuesday is on us, and because you have a mortgage, you're about to get one, you want to kind of find out what's happening with your money because Wall Street's trading it before you even sign paperwork. And everybody keeps asking me what happened to mortgage rates. So let me tell you what happened this last week. Now let's go all the way back to last week. Let's go to Thursday, the day before our last video. The Federal Reserve didn't surprise anyone. They held short-term rates very steady. Most people thought no change for the Fed means that mortgage rates should stay the same. Wrong, because mortgage rates are not set by the Federal Reserve. They're set by investors buying mortgage-backed securities and trading what they believe the future of money's value to be. Now, let's go to the Fed meeting. Long-term bond investors decided that they wanted more compensation after the inflation risk that was kind of commented on after that Fed meeting and when Chairman, I'm not even remembering his name, the new Fed chairman, I did go figure. But I'm not going to waste time trying to figure it out because it's going to pop into my head as I get deeper into this thing. Well, because of his words, a lot of people are like, there may be a little bit of risk. And they traded it as a result of that and got a little bit uglier, right? Mortgage-backed securities weakened, mortgage rates moved a little bit higher. Friday, we got hit by something almost nobody talked about, right? Which is a more massive foreign exchange trade between the United States and Japan, creating unusual volatility in the treasury market. At the same time, higher oil prices kept inflation concerns right at the forefront of everybody's thought process. So bonds fell, mortgage-backed securities took another hit. Then Monday, interesting, things starts calming down. Oil prices eased as geopolitical tensions cooled a little bit. Bond prices improved. Mortgage-backed securities actually gained ground. But here's what's interesting. Interest rates didn't hardly move at all. Why? Because lenders want proof that the rally would last long before passing those gains on to borrowers. Now, let's look at this morning. Let's take a look and see what we got going on here because this is definitely something you want to see when it comes to the mortgage-backed securities and what's driving that. As of this morning, we can see right here, the market is still trading on hope, but it's still cautious, waiting for the next inflation signal, waiting for the next economic report, waiting to see whether or not the recent improvement is actually real or just another pause in a volatile market. Now, remember, when you're locking your mortgage, you're entering into this trade right here. You're trading in the value that this is at. Now, we know now, as we just talked about, it don't always correlate to the rate because the banks want to see that this is something that's going to hold ground or is it going to go back down to the bottom of this channel? As you can see right here, we're hitting a peak that we had been experiencing in the past. Peaked out right here 4 trades ago. Now we're peaking out again. Will it have steam to get above this? Also got a moving averages above it. Will we get back to the top of this channel? Kind of hard to say. So when you're looking at this and you're making this trade, remember the investor who's buying into the mortgage-backed securities is buying your payment secured by your promise to repay. You're buying control of a cash flowing, amortizing, income producing asset. Wall Street's trying to preserve the purchasing power of its money. You're trying to use that money to control productive assets. Those are two completely different objectives. That's why I never asked, did rates move? To ask what changed Wall Street's opinion about the future value of money. That's what's moved mortgage-backed securities. That's what moves your mortgage and moves your payment. If the deal works with today's interest rates, then it's a good deal. If the interest rates have to move to make the deal work, then it's not a good deal. You have to look at it from those perspectives. So when you look at it from that direction, can you lock up money for long term? Is going to help you to acquire that asset that you get to amortize with somebody else's money, appreciate with the market, write off on your taxes, and get cash flow and ever increasing cash flow as rents going up. You have to understand your market. What market is going to deliver that? Will that market work in today's market when it comes to the interest rates? And if it doesn't, you don't have a deal. Shopping for a rate to make a deal work is not a productive way for you to be an investor. So get in the trade and record your canal.